Welcome to Inside Automotive with Jim Fitzpatrick.
Hey everyone, Jim Fitzpatrick. Thanks so much for tuning in to another edition of Inside Automotive right here at the CBT Automotive Network. The buy-sell market is moving fast. Today we're talking with Erin Kerrigan, founder and managing director of Kerrigan Advisors. You've seen her here before on CBT News to break down what's happening, how valuations and transactions are changing, and what dealers can do to stay ahead of the curve. So welcome, Erin. Thank you so much for joining us on the show.
Thank you for having me as always, Jim.
Sure. So let's jump right in here. How is the constantly changing tariff landscape impacting the buy-sell market? Which, by the way, I might add, we haven't been talking a lot about tariffs lately on CB. Every now and then, but of course, I think we went through this huge storm of conversation about it. But how's it impacting things?
Well, I think it's telling that you haven't been talking about it that much, and that it hasn't impacted it that much at all. And we actually did a survey. We have our dealer survey that we do every year, and I'll give you a sneak peek on one result. We did ask about tariffs, and the 600 dealers that responded to our survey, which is one of the largest I think it is the largest of its kind, of specifically dealers, the 41% said tariffs weren't impacting their business at all, which is somewhat surprising because it is certainly impacting inventories. I mean, I do speak to dealers all the time, and they do have some impact. But nonetheless, here today, it really is not impacting the buy-sell market. And even if you look at the financial markets, the 6 publicly traded new car retailers, their stocks are up about 5% year to date. Now, CarMax is down quite a bit because they missed earnings. Right. So the Kerrigan Index, which includes CarMax, is not up year to date, mostly because of CarMax. The other companies are, if you take all those and remove CarMax, the index is up 5%. So I think the financial markets, the dealers, everyone expects this is going to get resolved, although I think most of us thought it'd get resolved this summer, and here we sit in the fall. So it's not having an impact. Exactly.
And the question of did it impact your business? It could right away somebody thinks negatively, but could also impact your business positively. So if you're a Chevy dealer, for instance, I've spoken to a lot of them. They're having a pretty decent year. And a few of the dealers I've spoken to said, the tariffs have impacted my business positively just because of kind of the perception out there among consumers and car shoppers that, I should probably look at buying an American car and avoid any kind of tariff on there. Have you seen that at all?
100%. The domestics are definitely benefiting also in terms of the buy-sell market. We have seen them take share in the buy-sell market. There is more demand for Ford, Chevrolet, even Stellantis is back on the shopping list. So, which is a big deal and a big change. So I totally agree with your comment, Jim, in that the impact of tariffs, if anything, is actually causing a greater interest in domestic franchises. That being said, we just sold a Porsche JLR Audi in Louisville, Kentucky, the Bluegrass Motor Group, and despite the fact that at different times, literally JLR was not sending cars, nor was Audi. Right. There was tremendous demand for that franchise also. So I do think that, to your point, not everyone is having a negative implication of tariffs. Many are seeing margins improve in some cases because the supply is down, and so it is a very interesting situation. I think if anyone had asked the implications before the tariffs were announced, we would have thought that it'd be pretty bad. But in fact, it's really had no effect on the buy-sell market, and really we're not really even seeing effects, if anything, only positive on valuation.
That's great. Wow, that's fantastic. All right, so our next topic here, have you seen a change in valuation with recent interest rate adjustment? I mean, that seemed to get some publicity out there. And then, of course, the fact that the Fed, Powell said, hey, we might be looking at another couple of reductions here by the end of the year. But I would think that's big news.
You really would think it. And of course, traditionally, as interest rates go down, valuations typically go up because your cost of capital goes down. And so you're in a position as a buyer to, you can afford to borrow more, if you will, right, for an acquisition. However, this credit spreads have been very tight. They're actually historically as tight as they've ever been on a corporate level. So
Really?
that is certainly meaning that the implications of change in interest rates aren't quite as significant as they were. And I think most importantly, because our transactions aren't that heavily levered, and the fact that dealers still have a tremendous amount of capital on their balance sheets. Just by way of example, the publics continue to reach record levels of cash on their balance sheets. And since 24, and just in the first half, they increased that capital by $500 million. So
Wow.
That's a lot of capital.
Yeah.
And while certainly individual dealers are seeing their balance sheets maybe shrink if they have franchises that are more challenged, the largest diversified groups continue to be frankly flush with cash, and they certainly haven't spent it all of it on acquisitions or on other things that they might enjoy. They just have so much cash they probably couldn't even do that. So there is just a lot of capital out there for acquisitions, and I think that's why a reduction in interest rates hasn't had as big of an impact on our industry as it might in other industries. Because the market still is just very well funded.
Yeah, yeah. Why is there a tightening of the credit or the availability of the cash?
No, there's not a tightening. The credit spread is as low as it's ever been.
Gotcha.
So meaning that the premium that a commercial borrower has to pay for debt is never been lower.
Gotcha. Thanks for clearing that up. So all of that said, what inning do you think that we're in as it relates to industry consolidation?
It's such a good question. It's one we often talk about at Kerrigan Advisors. Where are we if you lift up and look at consolidation? I mean, we see the industry has been shrinking by about 50% every 30 years in terms of the number of dealers. That's just if you look back historically at the auto retail industry. And so we're probably tracking to eventually go from 10,000 dealers in 2000 to about by 2030, maybe 5,000. So we're tracking downward for sure.
Yeah.
That being said, the top 150 only represent 27% of dealership rooftops. Now they represent 33% of revenue. So they have the higher volume stores. And so that's interesting. And that has grown quite considerably in the last decade. In fact, they're tracking to be in 15 years, the top 150 are tracking to represent 50% of the industry's revenue. Which we do think could be an interesting tipping point.
Yeah.
And so that's something that we look at. The other thing that we look at is, okay, well, maybe broadly we're not that consolidated. However, what about the top growth metros, major metros in the US? Now, when you look at that from that lens, what you see is that actually we're very consolidated. For instance, the top 10 metros, fastest growing metros in the country, you think Orlando, Tampa, these kind of cities, Dallas, the top 150 groups own 72% of the top luxury franchises in those markets on average.
Wow.
So there's hardly any left to buy for non-top 50s, top 150s. And then when we looked at just Toyota, which is the highest demand franchise, so how consolidated is that franchise? Well, in 2 of the 10 markets, it's 100% consolidated. All of the Toyota stores are owned by top 150 dealership groups.
Wow,
that's in Raleigh and Tampa.
Wow, that's interesting.
So that's pretty. So again, I think what this tells us is on a regional level, we're starting to we're further in on our innings. On a national level, we're not quite there, but on a regional level, you're starting to see pretty significant consolidation. And another data point to that is that in the last year or so, the majority of transactions occurred in the buyer was already in the market. In other words, the buyer owned 3 stores and they went and bought 3 more. So buyers are really focusing on growing their regional footprint. And so that's the stage of consolidation we see our industry in.
Okay. Now for the on the OEM side, with 100% of those Toyota stores being owned by the big boys out there, is there a saturation point? Because I know that in many cases OEMs are like, hey, you have too many Toyota stores, you've got too many XYZ stores in one particular area. When does that start to really create a problem where a seller of a store says, I've got a buyer, and they go, yeah, but we're not going to approve that buyer because of all of the stores they currently have in that market?
Well, it's not a problem yet because remember, there's 150. So
Okay.
the top 150 dealership groups. I mean,
Yeah, I
many
guess you're right.
industries.
Yeah. It's not necessarily
many industries. But it can be a problem. For instance, when we represented the sale of the Toyota store in Tampa, which was the last remaining dealer's Toyota store in that market that was not owned by a major consolidator.
Right.
Some of the consolidators already own too many stores in that market, so they could not buy that store.
Right.
So, the list was smaller because I think the Publix, this is from memory, but I think each of the Publix owned, several. And so you really didn't have many players yet. But of course, a lot of people want to buy a Toyota store in Tampa. So it wasn't, there was still tremendous demand. Right. And the Gettle organization, which is a top 150 private dealership group, was the ultimate buyer of that store.
And then we also know that OEMs will say, all right, we'll let you buy that store so long as you give up one of your other Toyota stores. So I'm sure those managers of those consolidators go, okay, where's the weakest link? And we'll pick up that Tampa store and we'll drop off this low producing Toyota store. So right?
Yeah, we talk a lot at Kerrigan Advisors about, we're kind of transitioning from a game of from a game of checkers to chess, right? So there's a lot more strategy that goes into this, right? Because it's not simply moving the checkerboard. It's now you got to sort of think very strategically on how you grow your business and ultimately, why do people buy more dealerships? Yeah. Usually they're looking to enhance the value of their group. So
that's right.
Yeah.
I would imagine too, we're gonna at some point in time see one publicly traded company try to acquire another publicly traded company as a merger, and that's going to be problematic in terms of the OEMs and getting approval on, one's got 300 stores and another one's got 150 stores, and right? Because that's just going to...
I don't have any strong opinion about. I think that, quite honestly, what you're going to see is, I think those that aren't in the top 150 are going to be working very hard, again, playing chess, to figure out how to be in the top 150, because I believe that once we get to the 50% of the revenue being represented by that cohort, you're going to start seeing some real changes in the industry where it's going to be harder for a smaller dealer to compete when there's that much consolidation. So I think everyone's going to be focused on getting there. And I think that some of the folks in the top 150 will sell also, like the Coons transaction. I mean, the Keys, Howard Keys is still in the business, but they did sell their mothership business. Right. And so I do think you're also going to see transactions in that top 150 group. So there's going to be shuffling of that list, but ultimately we will hit a tipping point where they're going to represent 50% plus of the revenue of the industry. And my estimation is that's a significant moment.
Sure. I am surprised, Erin, that we haven't seen more publicly traded or more car groups, auto groups going public. I mean, there just seems to be still this 6-7 number. And it would seem to me, with the money that's out there and the private equity players and the market, and ever since Berkshire Hathaway jumped in, and there's been so many positive things about the auto industry, that it seems to me that there would be more publicly traded auto groups out there. And there just hasn't been. There hasn't been that many that have, right? When was the last time we saw...
The IPO market has not been very strong in the last year. That being said, I would say that in general, if you think of the capital markets, the private side of the capital markets have become so robust that what you are seeing is dealers tapping into the private capital investors, private equity, family offices. So I think that is where we're at in terms of the industry tapping into professionally managed capital. It's just not. There's a lot of headache that goes with being a public company. And, you can ask any of the CEOs of the current 6 public companies, and they will tell you that, right? It's a lot of work, and I think that turning to private equity, and that's a broader term. It includes family office, is a much more attractive way. Now, you are also seeing, though, you have seen private dealers tap into the bond market. That is happening. And the Morgan Group tapped into the bond market. Garf has tapped into the bond market. I think you're going to see more folks do that, especially going back to your earlier question, especially with interest rates going down and be even more attractive. Again, remember I mentioned the credit spreads were so thin. That's why it's been attractive even with higher interest rates for those companies to tap into the bond market.
Gotcha. Makes sense. What are your thoughts on all the new image programs being rolled out by the OEMs?
Well, I think that is definitely not going to be great for the buy-sell process and not for valuation. I mean, the challenge that we always have is that when there is a new image program, concocted in a boardroom of an OEM, they always are very nice to their existing dealers about, oh, no, not necessary to do this. And then the buy-sell comes, then it's like, and this slam. Is my chance to, take a pound of flesh. Right. And so it is negative for valuation because the buyer usually has to do the image program. And these image programs have become much more expensive just by virtue of the inflation we've seen.
Oh, no question. You just mentioned the sale of the Porsche store in Kentucky, and man, those new Porsche stores, those destination point are unbelievable.
Yeah, and that's impacting Porsche's valuation. I mean, the reality is it might work in some markets, but when land is so expensive and the facilities are so expensive and supply and allocation is so limited, sure, you're going to give me 20% more cars. It's still not enough cars to make up for the cost of this building.
That's right.
So there is a challenge there, no doubt. And I think at this point I can't even count the dizzying number of OEMs that are announcing one new program after another. I don't know what was in the water in 25, but we've got, I think, 6 or 7 new beautiful buildings that are going to not sell more cars that dealers are being asked to build. And so this is, one of the reasons that the franchise laws are so important. And I always encourage dealers to really lean into their associations. I do think I agree with Don Hall that the letter that the OEM sent to the Department of Justice claiming that franchise laws were
I know. It's crazy.
Not legal. Yeah. It was an aggressive move and a shot across the bow. And we all that care a lot about the value of these businesses and what dealers have invested personally in generations in these businesses need to continue to be very vigilant in supporting all the associations that make sure that dealers get a fair shake. I mean, dealers have mortgages and have all sorts of things that there are reasons behind all these franchise laws. And and so I guess we'll wrap up with that. That is so important. So I really do credit all of the associations for the hard work that they do and believe it's a very important thing to support your association.
Totally agree. Erin Kerrigan, founding and managing director of Kerrigan Advisors. Thank you so much for joining me on the show once again. I know that our dealer viewers get a lot out of your visit with us, so thanks so much.
Thank you so much, Jim. It's great to be on.
Thanks for watching Inside Automotive with Jim Fitzpatrick.